Real giant.
That's the old picture.
Exactly. This story is about a huge shift, a corporate metamorphosis, really. We're looking at how this massive company is aggressively trying to become a consumer and tech leader.
That's the core of it. We're digging into the financial reports, the strategic plans, specifically around this giant digital leap everyone's talking about.
It's less about the Jamnagar refinery history now.
Much less. It's about what's driving the valuation now and, well, how they actually plan to make money from all these new ventures.
Right, and that's our mission today. How did RIL get into this, frankly, pretty strong financial spot after spending just astronomical amounts for years? And crucially, where's the growth coming from next?
Because the market is expecting big things.
Yeah, like a 18% jump in earnings per share compounded annually over the next, 3 to 5 years?
That's the number being floated, yeah. And it's supposed to be led heavily by the digital and retail sides.
Okay, so the excitement is basically that the big pivot, the big spend is done, and now it's payoff time.
That's the expectation baked into the analysis, yes. Payoff time.
But to really get that payoff, we should probably glance back quickly, right? The foundation. RIL started way back, 1958, textiles, actually.
Right, textiles first, then the big move into energy, petrochemicals, and eventually that Jamnagar refinery. World's largest back in the early 2000s. Kind of a huge deal.
A very big deal. But the last decade or so wasn't really defined by refining profits, was it? It was defined by spending. Massive spending.
Oh, absolutely. It was an incredible gamble moving into the consumer and digital space. It needed just epic amounts of capital, primarily building out Geo, the digital infrastructure.
How much are we talking?
Okay, so between fiscal 14 and fiscal 20, RIL poured in INR 6,680 billion. That's what, over 80 billion US dollars in CapEx.
6,680 billion rupees.
Yeah. And that kind of spending, obviously, it holds back your immediate returns. It needed serious long-term vision and a lot of debt initially.
Which explains why the balance sheet looked the way it did for a while. Heavily leveraged. So that heavy spending phase, is it over now?
Mostly, yes. The big capital expenditure cycles, especially for the initial 4G rollout, seem to be largely complete. And that changes everything financially.
How so?
The company is now moving into what the reports call a strong free cash flow generation phase, FCF.
Okay, FCF. For anyone not totally up on finance terms, what does that actually mean for RIL? More cash to invest, pay debt?
Both, really. It means they're starting to generate way more cash than they need just to keep the lights on and maintain current operations.
Right.
So that FCF yield, it's a key measure of how much cash the company spits out relative to its value that's expected to jump. Big time. From just 2% back in FY20, potentially up to 7% by FY25.
So from 2% to 7%, that's a huge increase.
It's significant. And that generated cash becomes the engine for the next phase. It lets them grow, maybe make acquisitions, without needing to borrow like they did before.
And speaking of borrowing, this FCF phase kicks in right after they did a massive cleanup of their debt, didn't they? They aimed to be net debt-free by 2020.
And they actually hit that target, which was, frankly, remarkable given where they started.
How did they pull that off so fast?
Strategic fundraising. The big one was selling off a chunk of Geo Platforms JPL. They raised INR 1,521 billion.
Wow.
By selling about a 33% stake, roughly 32.95%, to major global players. Think Facebook, Google.
Right. The big tech investors came in.
Exactly. It did two things. Rapidly deleveraged the balance sheet, and it also put a huge validated market value on this digital platform they'd just spent billions building.
Okay, let's unpack that digital platform then, Geo. The spending's done, the debt's down. Let's talk about the telecom revolution Geo sparked. Launched in 2016. It didn't just get subscribers, it blew up the whole market, right?
Blew it up is a good way to put it. Super cheap 4G data and calls. It basically forced industry consolidation. India went from, 15 mobile players back in 2012 down to just 4 by the time these reports came out.
4 players left standard.
And Geo scooped up users like crazy, over 390 million by late 2020. But that disruption, it came at a huge cost to the industry's finances.
Which brings us to ARPU, average revenue per user.
The magic number in telecom.
And the reports are flagging this as a major issue, aren't they?
A critical issue. India's ARPU, when you compare it to the country's nominal GDP per capita, had fallen to just 0.6%, historically low.
And before Geo, what was normal?
Before Geo shook things up, say back in FY14 to FY16, that ratio was more like 1.3% to 1.5%. So Geo's entry effectively halved the revenue per user relative to income. Great for consumers initially, but financially stressful for all the operators.
Like, can the industry even survive at these levels? Or is everyone just going to have to raise prices a lot?
The consensus in these reports is clear. Massive tariff hikes are basically inevitable, not really a choice.
Why inevitable? What's the threshold?
The models suggest the industry needs ARPU to get up to around INR 230 to 250 per month by FY25.
Yeah.
It's nearly double where it was,
Double, just to be viable.
just to justify the next round of big investments like 5G rollouts. Total industry capex needed is estimated around INR 8,000 billion cumulative. Without hitting that INR 230-250 ARPU, they can't achieve a decent pre-tax return on capital, maybe 12-15% ROCE. It just doesn't work financially otherwise.
So it really is a forced correction. And the situation for competitors kind of underlines this, right? Like Vodafone Idea.
Absolutely. VIL, Vodafone Idea, is highlighted as being under immense pressure. They reportedly needed their ARPU to more than double to over INR 270 just by FY23 to sort of stabilize.
And if they don't make it?
Well, the risk flagged is that the market consolidates further down to a duopoly. Basically, Jio and one other major player, likely Airtel.
So either way, prices have to go up. And Jio seems positioned to benefit regardless. If industry revenue doubles to around INR 2,600 billion by FY25, as predicted, how much market share does Jio grab?
Projections show Jio increasing its revenue market share, or RMS, to about 50% by FY25. That's up significantly from 36% at the end of FY20.
50% market share. How do they plan to get there while prices are rising?
Well, first, ARPU is expected to grow steadily, maybe 10% CAGR from FY20 to FY28. But critically, Jio's strategy is likely to maintain a price advantage, keeping their tariffs maybe 10% to 20% below competitors.
So even when prices go up overall, Jio remains the relatively cheaper option.
That seems to be the plan. Capture share, drive ARPU up across the board, but stay positioned as the value leader.
Okay, but here's where the story gets even more layered, right? RAL isn't just banking on charging more for data plans. It's about monetizing the whole ecosystem built on top of that connectivity. Jio Platforms Limited, JPL.
Exactly. The pipes, the connectivity, that's the foundation. But the real value, or at least the projected future value, comes from everything else they can layer on top, using their tech capabilities, AR, VR, AML, IoT.
The whole tech alphabet soup. So what's the total potential value they see in this digital monetization piece?
The reports estimate that these various digital services, beyond basic connectivity, could contribute around INR 105 per share to RIL's overall valuation. That's a huge chunk of the growth story.
Okay, INR 105 per share just from digital extras. Let's break that down. What are the big pieces? Video OTT, stuff like GeoTV, GeoCinema.
Yeah, video's a big one. Right now, those services are mostly used to keep subscribers loyal, retention tools.
But the plan is to charge for them.
That's the projection. The potential upside just from video content is estimated at INR 83 per share.
83 rupees. Just from video. How do they get to that number?
It's based on assumptions like getting about 30% of their subscriber base, which could reach nearly 500 million users by FY25 to pay something like INR 100 a month for premium access. It's about converting those free users into paying ones.
Okay, that's video. What about audio? GeoSavan.
GeoSav, yeah. It runs on a freemium model, some free access, some paid tiers. The extra value potential there is estimated lower, around INR 8 per share.
Why lower?
Well, the key thing with GeoSavan is adoption. It has a big user base, maybe 100 million monthly active users at the time, but only about 20% were paid subscribers. So lots of room to grow paying users, but maybe a tougher conversion than video. Still, INR 8 per share adds up.
And the third piece you mentioned, IoT, consumer smart devices.
Right. Internet of Things, leveraging investments they've made in tech companies like Redesis and Haptic. This market itself is growing fast, potentially an $8 billion opportunity in India by 2024. The contribution to RIL's value from this is estimated around INR 14 per share.
So you've got video, audio, IoT. How does RIL plan to tie all this together for the user? Is that where the super app idea comes in?
Precisely. The super app is the logical next step. A single interface where they can cross-sell everything. Telecom, entertainment, e-commerce, payments, maybe even financial services down the line.
And the fuel for the super app is the user base.
Absolutely. You've got Jio's own massive subscriber base, over 390 million. Plus, think about those strategic partnerships, leveraging Facebook and WhatsApp, which also have, 400 million plus users in India? That's a huge built-in audience for commerce and other services integrated through the app.
Build the highway, then build the mall accessible only from that highway.
Pretty much. That's the digital ecosystem play.
Okay, let's switch gears to the other big consumer engine, retail. Reliance Retail is already huge, right? India's largest retailer.
By far. Over 18,000 stores across all the key areas. Grocery, fashion and lifestyle, consumer electronics, dominant physical presence.
But again, like with digital, the story here is also about a big financial improvement, isn't it? Specifically, that return on invested capital number.
Yes, the ROIC turnaround in retail was quite dramatic. It went from a pretty modest 6.5% back in FY16 up to a very healthy 27.1% in FY20.
27% ROIC, that's really strong for retail. What drove that? How did they become so much more efficient?
It points to serious operational tightening. Think about this. Between FY16 and FY20, their core retail revenue grew fivefold, quintupled.
Okay.
But their store count only doubled in the same period.
So much more sales pouring through each store or through their online channels connected to those stores.
Exactly. Better throughput, better inventory management. And that inventory point is key. They slashed the number of days inventory sits on the shelves, inventory days, from 104 days in FY16
Which is quite long.
down to just 26 days in FY20.
Wow. From 104 down to 26. That frees up a ton of working capital, turning products over almost 4 times faster.
It's a massive efficiency gain, and that operational strength really underpins their next big retail push, Geomart.
Geomart. This is their new commerce venture, right? The omni-channel play.
That's the one. And it's a significant part of the valuation story, too. Geomart itself is valued on an enterprise value basis at around INR 115 per share in some of these reports.
INR 115 a share just for Geomart. What's the core idea behind it that justifies that kind of value?
It's heavily focused on digitizing India's vast network of Kirana stores.
Okay, explain Kirana stores for listeners maybe not familiar.
These are the small neighborhood mom-and-pop grocery stores, millions of them across India. They're the backbone of traditional retail, what's called general trade.
So Geomart wants to bring them online.
Essentially, yes. Provide them with tech, logistics, sourcing, and connect them to customers through the Geomart platform. The valuation is based on capturing a decent chunk of this digitized general trade market. The report suggests aiming for about a 10% market share by FY30. It's about organizing the unorganized market using tech.
That's ambitious. What was the immediate outlook for retail back when these reports were compiled, say mid-2020, pandemic impact?
Yeah, the pandemic definitely shaped the near-term view. Growth was really being carried by the essentials. Grocery and consumer electronics did okay, but the fashion and lifestyle segment, which usually has higher margins,
Took a big hit.
faced major headwinds, store closures, lower footfall. The projection was for a much slower recovery in throughput for fashion compared to groceries or electronics.
Okay, makes sense. Let's quickly touch on the legacy business, energy. The reports weren't exactly bullish on refining and petchem margins, were they?
No, definitely not in the short term. They cited roughly an 8% drop in global oil demand in 2020 because of the pandemic, plus ongoing new capacity additions worldwide, keeping pressure on margins. Not a growth engine right now.
But RIL was still seen as being relatively better placed than other refiners. Why?
It comes down to their specific assets and operations. They have highly complex integrated facilities, think Jamagar. They have locational advantages, and apparently superior strategies for sourcing crude oil and placing their refined products in the market.
Does that translate into better performance even in a bad market?
It seems so. The reports noted that even during the really tough initial lockdown phase, March to May 2020, RIL kept its plants running at over 90% utilization.
While others were much lower.
Yeah, compared to maybe 50% to 80% for many other refiners globally, that integration and scale provides a buffer, a resilience that others lack.
Looking longer term in energy, though, the focus seems to be shifting dramatically towards green energy. Carbon neutrality goal.
Absolutely. They've set a target to be carbon neutral by 2035. That's a huge undertaking.
And it involves serious investment.
Big money planned for things like green hydrogen, large-scale solar manufacturing. It signals that while the current oil to chemicals, or O2C, business is a cash cow today.
The future investment is elsewhere.
Right. The future focus is clearly shifting towards the consumer businesses and renewables. Oh, and that proposed deal, selling a 20% stake in the O2C business to Saudi Aramco.
Yeah, what happened with that?
It got delayed, largely because of the difficult energy market conditions at the time, but strategically, it's still seen as potentially important for RIL to lock in a long-term buyer for its crude oil needs. Still on the table, just paused. So if you pull all these threads together, the digital push, the retail transformation, the energy shifts, the big picture, the really fundamental takeaway is how RIL's earnings mix is changing dramatically.
How dramatic.
Think back to FY16. Back then, energy refining, petchem exploration made up something like 93% of RIL's EBITDA. Almost everything.
93%, okay.
Now, fast forward to the projections for FY25. The consumer businesses, digital plus retail, are expected to generate around 56% of the EBITDA.
Wow. From less than 10% to over half. That's a complete flip.
It's a massive internal rebalancing of where the profits come from.
Okay, so wrapping this up, what does this all mean for you, the listener? You've got RAL having finished this huge spending cycle, cleaned up the debt, now poised for strong cash flow generation.
Driven by that projected 17–18% earnings growth, mostly from consumer digital and retail. That's the bull case in a nutshell.
But there are definitely risks baked into. The big one seems to be that ARPU hike in telecom that needs to happen for the whole industry, not just Geo.
Right. If those hikes don't materialize as expected or are much smaller, that's a major risk. Continued weak energy margins are another potential drag, and actually getting people to pay for all those digital services beyond basic connectivity, that's still a hurdle they need to clear. Monetization isn't guaranteed. Which brings us back to that telecom fragility. We've heard the industry basically needs ARPU to almost double for long-term health and investment. So here's a thought to leave you with. What's more striking here? Is it the sheer necessity of that ARPU hike for market stability? Or is it the hidden sort of contingent value embedded in RAL's projections specifically, that INR 67 per share valuation component that analysts factor in if a major competitor like VIL were to fail, pushing the market to a duopoly?
So are we looking at a necessary market correction, or are we potentially valuing a company based partly on a competitor's potential failure?
It raises that interesting question, doesn't it, about the line between driving market change and benefiting from market instability. Something to think about.